Welcome to the start of 2026, a year where the markets have remained eerily cool while the geopolitical stage is white-hot. We are witnessing a fundamental shift in the global order. President Trump is shuttling between Moscow and Kyiv, while China conducts live military drills around Taiwan and the Middle East remains on a knife edge. For the modern investor, the traditional noise of data points has been replaced by this signal of structural instability. We are no longer just tracking earnings. We are tracking the movement of carrier strike groups and the breakdown of post-World War II institutional norms. The question isn't whether the world is changing, but whether your portfolio is prepared for the uncoiling of the old global consensus. Look at the silver-to-oil ratio. For the first time since the Hunt brothers tried to corner the market in 1980, an ounce of silver costs more than a barrel of oil. With silver hitting $70 an ounce and oil sliding toward 58, the historical average ratio of 3.8 has completely inverted. This isn't just a market quirk. It is a profound indicator of uncertainty in the global monetary system. When silver outperforms as a financial asset while oil stays suppressed, it suggests that investors are hedging against a civilizational shift, fearing that the era of cheap, stable energy and predictable fiat currency is giving way to something far more volatile. Across the Atlantic, the European Union is facing its own existential crisis. While the bloc managed to raise 90 billion euros in collective debt for Ukraine, it remains paralyzed by internal dissent. The standoff over 210 billion euros in frozen Russian assets, pitting the European Commission against Belgium's Euroclear, highlights the EU's unanimity trap. At the same time, the failure to sign the Mercosur deal reveals a continent torn between its industrial needs and its agricultural lobbies. Europe is trying to stump up for its own security as the transatlantic relationship with Washington frays, but the political gymnastics required to do so are increasingly exhausting for investors. In Washington, the Federal Reserve is under a level of political pressure unseen in modern history. As Jerome Powell's term nears its end, the shadow of Kevin Hassett looms large. The potential nomination of a supply-side loyalist to lead the Fed has raised alarms about the end of central bank independence. President Trump has openly called for rate cuts to 1% to finance the national debt, effectively turning the Fed into a tool of fiscal policy. For the markets, the risk isn't just about the next quarter-point move. It's about the loss of the predictability that has served as the secret sauce of the U.S. financial system for decades. We are seeing what economists call fiscal dominance, the effective merging of the Fed and the Treasury. The resumption of reserve management purchases, buying $20 billion in T-bills a month, is being cast as simple liquidity management, but many see it as a coordinated effort to suppress long-term yields. By leaning into short-term T-bill issuance and buybacks of longer maturities, the government is engaging in financial repression to manage a burdensome national debt. This undoing of the 1951 Accord means that monetary policy is now subservient to government debt management, a move that historically leads to long-term inflationary pressures. While legacy banks struggle with regulation, a new guard is taking over Wall Street, the private market institutions. From Apollo to Blackstone, these shadow bankers are eclipsing traditional investment banks in both wealth and influence. The average senior executive at a top private equity firm now earns nearly 7 times what their counterparts at legacy banks make. This isn't just about compensation, it's about power. Figures like Mark Rowan and Steven Schwartzman are now major players in everything from higher education to national security policy. As private equity expands into credit, insurance, and infrastructure, the systemic risk shifts away from regulated banks and into the opaque world of private capital. The Supreme Court's decision to strike down the administration's global tariffs under the Emergency Economic Powers Act was a massive blow, but the response was immediate and aggressive. By pivoting to Section 122 and 301, the president escalated the global tariff rate from 10 to 15% overnight. This Plan B has left $142 billion in revenue in limbo and forced U.S. companies to scramble for refunds. More importantly, it signals a permanent move away from free trade toward a reciprocal system where the president wields extraordinary executive power to reshape trade flows, favoring Taiwan over China and causing dismay among allies like the UK. Perhaps the most immediate geopolitical risk is the buildup for an open-ended conflict with Iran. With 2 carrier strike groups off the coast of Oman costing $8 million a day, the logic of use it or lose it is taking hold. Unlike previous targeted strikes, this mobilization suggests a goal of either regime change or total degradation of Iran's nuclear program. However, the The lack of a clear exit strategy or international legal backing has created deep uncertainty. Success in Lebanon and Venezuela has bred a sense of hubris, but as energy markets react, the assumption that war can be waged without a painful spike in oil prices is a high-stakes gamble for the global economy. To tie it all together, we are moving from a world of globalization to a world of fragmentation. The lucky 13% earnings growth expected for the S&P 500 is a fundamental tailwind, but it is constantly battling the headwinds of fiscal dominance, trade wars, and military escalation. The rise of private equity billionaires, the politicization of the Fed, and the aggressive use of tariffs are all symptoms of a new era where power, not just price, dictates market outcomes. For investors, the lesson is clear. Diversify away from dollar-heavy tech, look toward resilient sectors like utilities and healthcare, and recognize that in 2026, the most important chart isn't a stock price, it's the map of the world.